So I go to Calculated Risk blog, which is a private website. It's not a government website like the BLS.gov and BEA.gov websites we were just at. And as you can see, this website is also a relic of the 4:3 aspect ratio era. It was not created in the 16:9 era, and it's kind of stuck that way, just like my blog, The Futurist, was, which I started in 2006, because migrating to the wider aspect ratio messes up all the archives, and that's why he hasn't done it. But that was also a signal to me to go to YouTube and video production rather than text blogging. So what we want to look at over here is the JOLTS report for 2021, most recent one, BLS job openings, and how job openings in the United States are at an all-time high today. We are at almost 11 million job openings. This metric is called the Job Openings and Labor Turnover Survey, or JOLTS. Catchy acronym. So despite the fact that payroll employment is not at its pre-coronavirus high yet, there's certainly enough job openings for that. There are 11 million job openings. There's just not enough people who are willing to go do those jobs. Eventually this will normalize out and we will return to full employment again because, thankfully, an adequate amount of money has been printed and coronavirus has shaken loose the necessary amount of money printing. Even though the Federal Reserve and the economists don't understand why being forced to do that much printing was actually a good thing and a manifestation of market forces that was just speeded up by the COVID-19 crisis. So this is how you look at JOLTS to see how many openings there are in the US today. Blue is voluntary quitting, red are layoffs and discharges, dark blue are hires, and yellow is the most important line, the amount of openings present today, and we're at 11 million job openings, which is much higher than the baseline of 3 to 5 million that we were experiencing in the past, or even the 7 million during the booming pre-COVID-19 economy. So we return back to the Calculated Risk homepage and we look at trade deficit. Always choose the most recent one. The trade deficit increased to 70.1 billion in July, but what is the trend line? So we go over here. So this is the US balance of trade. Now, this is a very interesting but also unfortunate story, and I speak about this when I talk about how I predicted that oil prices would fall permanently. There was a time when oil imports were in fact the majority of the US trade deficit. The red line is all non-oil net imports. The black line is just oil imports. And around 2007, 2008, oil was a major portion of all of our imports, even in 2011, 12, and 13. But as I predicted in early 2011, technological innovation would crush the price of oil. That is exactly what happened around 2015. And the US not only stopped importing foreign oil, the price of oil also went down. So the United States' oil trade deficit totally went away. We actually have a small trade surplus from time to time. So oil imports being a huge drag on the US economy was a problem that was corrected with extreme ease because of the wonders of technological disruption and atom principles. However, the United States squandered a once-in-a-generational opportunity to erase its trade deficit altogether. All the money being saved by oil imports going away instead went into non-petroleum imports, mostly to China. And now 70 billion a month is the United States' trade deficit. It still is pretty high. It's actually rising quite a bit. It's not net going down despite oil going down because all of that goes to China. So the bigger beneficiary of the US hydraulic fracturing boom and the destruction of oil price pressure is not the United States, but China, because everything that we're saving by not importing oil from overseas is instead going to importing things from China, and China's economy is booming. They not only pay less for oil because we made the price of oil go down, so their oil imports cost less. We're also buying more from China. So they're the double beneficiary of the whole thing. And we could have been a beneficiary, but every single dollar that we're saving from oil imports going away has instead transferred directly into the red line. Therefore, the total trade deficit, the blue line, has not really gone down. Now, this is not adjusted as a percentage of GDP. There are websites that do that as well, and I have other videos about that on this channel. But still, it's a big rise when we could have gone to no trade deficit at all. And remember, in the 1990s, the United States had little to no trade deficit in the first place. And now for the final indicator, we go back to the Calculated Risk main website. And this is not a tier 1 indicator normally, but I believe we are on the brink of another real estate bubble and subsequent real estate bust, and that's why we look at the construction data. So construction spending in the field here. Construction spending is important because the lower interest rates and money printing, which is necessary, has unfortunately been done in a way that hyper concentrates in 1 to 2 sectors versus what I recommend, which is far more diffuse. sending cash directly to people. It's extremely obvious and elegant. It's too simple for these PhD economists to actually understand. So they have to make things super convoluted and inefficient, as is their nature. Construction spending rises whenever there is a reduction in interest rates and money printing. And the problem with that is anything that boosts real estate prices, which those two activities do, also simultaneously stimulates more construction of new homes. We had a big construction boom in the 2007-2008 period. That caused a real estate bust because too many homes were built. Then we recover from that. But now, because of what is going on, the Federal Reserve still buys mortgage-backed securities and does things to artificially prop up the housing market, not realizing they're just stimulating the construction of new homes. It's creating the same situation here again. And office and government construction is not happening anymore. Public means government. Blue means non-residential. And among non-residential, you have both retail spending, of which there's already a permanent and gigantic real estate glut because of the e-commerce revolution, as I talk about in this video here, as well as the glut in office buildings because of the telework revolution, which I also talk about over here. The only type of real estate for which there is still demand is housing, and that's being built. That's a good thing, except it's being stimulated by the wrong reasons because the Federal Reserve is trying to stimulate existing home prices, which induces the construction of new homes. And this is an all-time high level of construction. It's not the same percentage of the economy as it was in 2008, but it's still very, very huge because all of this has not been completely digested itself either, even 10 years later, 12 years later. And if you look at this in a percentage year-over-year growth rate view, you will see how extreme this is. Red, residential, same color scheme as before, that peaked at around 20% growth a year for 2 years, okay? 2004 through 2006 or so. Now we're at 30% year-over-year growth. And not that all this boom was fully digested. All this digestion and correction and that very deep recession still only recovered real estate in some parts of the United States, but not all parts. And now we have a new huge boom because the construction industry has to make money, but there's no demand for office or retail real estate anymore at all because of the telework revolution and the e-commerce revolution. These are very good things for consumers. These increase the standard of living for consumers, but the Federal Reserve thinks it can manage the economy while not even having the right hand talk to the left. Anything that is done to artificially boost home prices always stimulates the construction of new homes. And what will happen is, since people can do their jobs over Zoom and are now accustomed to teleworking, they will migrate to lower cost places. So it's actually the super expensive locations, namely the San Francisco Bay Area and New York City, that are extremely vulnerable because all this supply is being created in places that don't halt home supply construction, whereas those places do have zoning that prohibits the construction of new homes and does not let home construction match housing demand. So this is something to watch, because within a year or two, this percentage growth rate has to go down, which drags the rest of the economy with it, and the Federal Reserve will try and print more and more money, but it cannot print in a way that just stimulates the housing sector at the exclusion of everything else. That is absurd. The only thing that will work is sending cash directly to people, and a lot of the people who bought $2 million houses that are now $1 million, it just won't be possible to bail them out. The Federal Reserve has tried to do that, but like I said, they're putting more and more water into a sieve because home construction still happens, and even if Bay Area cities prohibit new home construction from occurring, it happens in cities that are hundreds or thousands of miles away, and those people can get Bay Area jobs and do those jobs over Zoom. And under technological disruption principles, that has to happen. I spoke about how oil prices were crushed by technological innovation, and therefore OPEC, which felt that it had completely unassailable power, was brought to its knees. The same thing will be true for all the real estate owners of expensive cities who believe that the jobs are here, so people have to be here, and we make them commute an hour and pay an extremely high amount of money. No, technology comes in and rectifies that distortion. And I also talk about the zoning tax in this video over here. So if you're interested in that topic, that is certainly a video to watch. But anyway, I don't want this particular video to be too long. So what we have here is how to look at 5 indicators of high importance, some of which you should always look at no matter what the economic conditions are, and some that are particularly relevant now because of certain problems that are arising in the economy due to mismanagement by either the federal government or the central bank, and the portent of problems to come that these indicators are harbingers of. So some food for thought for sure. I hope you found this video interesting, and if you like this type of content, I encourage you to subscribe to this channel. Thank you very much for watching.